Hi everyone, my name is Ahmed Rune and I'm happy to see you here today on Intermediate Accounting 1. Today we're going to look through Chapter 6 problems, especially on exercise 6.14 and problem 6.4. Stay and enjoy this video. Hi everyone, let's start from problem 6.4. First of all, read all the information and let's look through instructions. Prepare a schedule analyzing the changes in allowance for doubtful account for the year ended December 31st, 2025. We started from the amount, so we took uncollectible percent and multiplied it to account receivable balance. We took it and moved it to all the table, and after that, we summarized the whole amount. After, we need to show supporting computations in a good form. Hint: in computing the allowance, subtract 60,000 write-off. So let's start beginning balance. After that, we have other accruals. Let's put it. After that, we have write-offs and recovery. Desired balance as at 31st, 12th, 25th. And entry to be recorded. So let's start putting the all necessary numbers. Doubtful account was 130,000. Other accrual during the year, we have 180. In write-offs, there was a hint. Do not forget about the hint. We have 90 of bad debts were written off and 60 write off. So we put it with a minus and so here we have 150,000. Recovery here is written 15,000. And after that, we need to summarize all using sum function. After that, we have desired balance. It's the same as we calculated amounts. And from entry to be recorded, we just need desired balance minus our taken 175,000. And here we have $88,600. For request B, we have prepared the journal entry for the year and adjustment to the allowance for doubtful account balance as of December 31st, 2025. Let's start writing. We have in debit, we have bad debt expense. And on credit, we have other. So here we are. Our solution is ready. I hope that everything was clearly understandable. I hope I helped you. Now let's start from exercise 6.14. On December 31st, 2025, Harvey Cole performed environmental consulting services for Cascade Corporation. Cascade was short of cash, and Harvey Corporation agreed to accept a $300,000 interest-bearing note due December 31st, 2027 as a payment in full. Cascade is somewhat of a credit risk and typical borrows funds at a rate of 10. Harvey is much more creditworthy and has various lines of credit at 6%. First of all, let's go and look through instruction A. Prepare the journal entry to record the transaction of December 31st, 2025 for Harvey Corporation. Let's write firstly necessary informations for computing all the calculations. We have date 31st 12 2025. We have due date 31st 12/2027, and between we have 2 years. We write it as an N, and as you can see we have zero interest bearing notes. It's our fee value. We have 300,000. After that we have two credit risks, 6% for Harley Corporation and 10% for Cascade. And we will use 10% as for borrowers. Let's firstly highlight all the necessary information which we will use in our PV calculation. So firstly, we need to find present value in order to calculate and make our journal entry. PV is future value divided by brackets open 1 plus rate, you close the brackets, and power of n. So here our PV calculation, we take note divided by 1 plus 10% in the power of 2. So here we have our present value, and let's make it smaller. Good. And now let's prepare our journal entry for year 2025. We have firstly our notes receivable, 300,000. Discount on notes receivable. Here we take 300,000 minus our present value. And the last one is service revenue. It's our present value. Good. And here let's highlight our findings. And now let's move to instruction B. Assuming how corporation fiscal year end is December 31st, prepares the journal entry for December 2026. Let's start from the putting necessary information first of all, as we did previously. We have beginning carry value. It is our present value because as 25 ends, this PV goes at the beginning of 2026, and it happens with each year. We have rate of 10%, and here we need to find our interest revenue, and we need to find ending carry value. So let's first of all highlight our necessary information. Here you go. And now let's put the formulas of our interest revenue. So in order to find interest revenue, we take beginning carry value and multiply it on our risk. Let's compute it. Interest revenue. So we take our beginning carry value, multiply 10%, and here we are. So ending carry value, how we found it. It's not hard. So we take our beginning carry value and we add our interest revenue on it. So let's highlight. Here we go. Ending carry value is interest revenue our 247 plus our beginning carry value. And here we have our ending carry value. And here we have to prepare journal entry 2. But before that, let's make it. First of all, we remove request C. Journal entry for 2026. Now we put discount on notes receivable. Here we have our interest revenue. We put our values and just short it. Let's highlight our findings in order to ease. And let's continue with request C, our last request. So here we just copy paste the names. Now we have year 2027. We put ending carry value as beginning carry value for 2027. Risk, our rate is 10% as it was. Formulas in order not to mess up. So our interest revenue beginning carry value multiplied by 10%. Here we go. And now let's go and compute our ending carry value. So interest revenue plus beginning carry value. Here we have 300,000. Let's highlight again. So here we need to write our journal entry now for year 2027. We start from discount on net revenue. After that, we have interest revenue. Here we highlight it and we short our answer. Yeah, good. And at the end, it's not necessary, but it's better to write. We have collection at maturity. So we write this transaction too. So cash, 300,000, and net receivables, 300,000. Highlighted. So here you are. All the task is ready. We have request A, B, and C. Thank you for watching. I hope that I helped you. And now, goodbye.